Ladies and gentlemen, thank you for taking the time to be with us today and welcome to the M&A Masters program, which is our fourth webinar in this program. My name is Prasanji Chakravarti and I'm an M&A partner in Khetan's Corporate and M&A Group. I would like to extend a very warm welcome to this webinar to every one of you, whether you are in our audience in India or around the world. The M&A Masters program is designed to provide sophisticated education and discussion on contemporary M&A issues to experienced corporate executives, in-house legal teams, investment banks, intermediaries, and other participants or in people who are interested in M&A in India today. Our subject today is innovative M&A structuring. On the slide today is the agenda for today's webinar. As you can see, that a lot of things will be covered which is pertinent. If you do have any questions, please do submit them using the facility provided in the webinar portal. If you cannot cover all the questions which you raised during the webinar, we will definitely respond to you offline by email after the webinar in due course. Also, please note a copy of the presentation, the summary notes of what will be discussed today, and the recording of this webinar will be sent to you after the webinar as a matter of course. Now, in today's fast evolving India M&A landscape, deal making is no longer just about, let's say, valuation or synergy. It is about structuring creatively to address legal, tax, regulatory, and commercial complexities while still delivering the deal with speed and certainty. Whether it's a carve out to manage regulatory risk, a hybrid deal to bridge valuation gaps, or a deferred consideration structure tied to future performance. Innovation in structuring is now central to closing successful transactions. As markets mature and stakeholders grow more sophisticated, the demand for bespoke structures tailored to transaction strategic intent has never been greater. This session today brings together leading experts across legal, tax, and commercial domains to unpack the architecture of innovative structuring. We will explore how different deal forms, business transfers, partial stake sales, hybrid models are being deployed in India and how deal makers are balancing competitive objectives like regulatory compliance, tax efficiency, and enforceability. Our panelists will also share real life experiences, market shifts, and future forward strategies that are reshaping Indian M&A. With that, let's dive straight in. Now, let me take a moment to introduce our esteemed panelists for today. Everyone who has registered for this webinar should have already received an email with a summary of the presenters and their credentials. Suffice to say that they are all experts in the subject matter and extremely well qualified to express their views and opinions. Our experts today are Mr. Pramod Kumar, CEO and Head of Investment Banking at Barclays India, Mr. Sumit Arora, Executive Director in M&A Advisory at Axis Capital Limited, Mr. Bhavik Narsana, Partner in M&A and Corporate Team in KCO, and Mr. Bhavin Vora, Executive Director in Tax and Restructuring Practice at KCO. So with this, I think let's straight away dive into the questions and keep the discussions going. The first question, if I may just try to set the scene by, well, maybe throwing this question up for Pramod and Sumit. In today's Indian M&A market, what are the key trends driving the need for innovative deal structuring? Pramod and Sumit.
Yeah, thank you, Bhavin, and thank you for inviting us. Glad to be here on this very interesting topic. As you said, one of the biggest value that advisors like yourself and us as bankers bring to closing an M&A transaction is actually trying to bridge the gap in the commercial objectives of the two sides. Whether it's valuation, speed, etc. And therefore, need for innovative structuring has never been felt more than what we see these days today, right? I think that some of the trends that are very evident in today's M&A environment is increasing relevance of private equity players, right? Private equity players have become a pretty dominant um, factor in the volume of M&A transactions, in the successful closures of the M&A transactions. I think there are few things that therefore consequent to them as a different class of shareholders and kind of different objectives that really consequently lead to need for some innovative structuring, certain premises in the transactions. It's like private equity investors don't end up giving indemnities, right? As you know, they once they sell, they've got to distribute the proceeds to the LPs. Unlike a founder who on sale will give reps and warranties and consequential indemnities financial, private equity preferred not to give that, right? So therefore, from a buyer's perspective, increasing amount of burden of diligence therefore falls on them. Indemnities are never a perfect answer to lack of need for doing diligence, adequate diligence, but they do provide protection, right? So that's kind of one important factor, and I think the way buyers are addressing that is to take rep and warranty insurance, right? So that's kind of an interesting outcome of that's pairing. I think the other one increasingly we're seeing is involvement of listed companies in the M&A processes, and therefore complexities around minimum offer price. You could have situations where negotiated price could be lower because the tender offer price is to be determined by SEBI regulations. So that's another interesting aspect. The other one is with respect to private equity investors, we're seeing is them coming together with strategics to facilitate M&A, right? Recently saw the news around Warburg Pincus and Bharti Group joining to acquire, higher business. That's in the news. It's not concluded, but clearly shows. I think we also read in the press around Advent backing Indico Paints on Exxon Nobel transaction. So that's sort of another interesting trend we are seeing. I think the other one is succession planning leading to a lot of families, business houses undertaking M&A transactions. So ensuring continuity of founders' involvement for certain years is an important aspect in overall structuring of the transactions. One other last point before I invite Sumit to add in is increasing involvement of management teams to drive the outcome of M&A, right? So we're seeing private equity investors end up bringing in a management team. We're also seeing management team out actually reaching out to private equity investors to say, they could back them up and they could build businesses, right? There have been a number of examples of that in the market, which have been very successful in driving the valuation outcomes and value creation for investors.
Maybe Prasenjit, thanks for inviting us for this discussion. And Pramod has mentioned about private equity involvement, and one can not overemphasize in terms of how much importance or involvement of private equity investors have led to different structures being played out. Now, if just to put some things in perspective, more from a stats perspective, if you look at the number of transactions which are more than $50 million, which happen in India, approximately 25 to 30% of the transactions are where private equity investors are involved as a party, either as a buyer or as a seller. So that's the importance the private equity investors are playing currently in from an M&A perspective. And this is also largely because if you look from a capital markets perspective, the depth the capital market has achieved over the last couple of years, which have allowed private equity investors to take that kind of a bet and exit through the public markets over a period of time. And Pramod mentioned about private equity investors requiring management to continue, and that has also led to some kind of innovative structures being put together to incentivize management, which can be a retention based payout, or some kind on those lines, where over a period of time the management is professionalized and the private equity investors can exit through the capital market or through the public market. Another important thing, because of what happened on the capital market side and also on the M&A market overall, even in terms of the valuation or also in terms of the deal sizes, I think we have matured as an M&A market over the last couple of years, and especially after COVID. Where it used to be a lot of cash transactions, I think a lot of investors these days are open to consider non-cash structures, and you see it, in the last 2 months or 3 months, a lot of transactions are being consummated through mergers or demergers, which were largely limited to internal reorganizations. And like, to case in point is Esther DM and Quality. That's a merger which is happening. Cohance, merged with Suven Pharmaceuticals. So there are a lot of transactions which are now being evaluated from a non-cash consideration perspective, where involving a merger or a demerger. Another point, which is sort of structure which is playing out, especially from a private equity investor perspective, because of the increase in the valuations and the deal sizes, is uh, uh, they're being cautious in terms of not putting the entire money upfront. So there are structures like a deferred consideration which is being played out, or an earn-out structure. And you did mention about in your opening statement, these kind of structures being played out. So those are the kind of things which are becoming more in play in terms of as the market evolves and the market matures. I think another important point to, or give you an example of where it says, an amendment in open offer regulations, wherein delisting was amended in 2021. And just to emphasize the importance of private equity investors, the first transaction which was tested post that amendment was where the private equity was an acquirer. So the point that I'm trying to make is, as the regulatory landscape also evolves and the buyer and the seller universe, expands, I think we'll see these, more innovative structures like deferred consideration, management incentivization, or management buyouts, backed by PE funds, and mergers and demergers, where there is valuations are high and people may not want to pay out the entire thing upfront, think of a non-cash consideration. So those are the kind of, structures which may play out over a period of time, or the trends which we are seeing currently.
Thank you. Thank you very much, Pramod and Sumit, for this wonderful opening and laying out the context and stage. Now, maybe for Bhavik to come in. Bhavik, the next question is, a very interesting one. That from a legal perspective, what structures are you seeing being used currently in India? Uh, like business transfer, slum sale, carve outs. There may not be exact statistics, but given your vast experience, what's your sense and pulse on these structures?
Thank you, Prasanjeet, for bringing me in, and I think it's always a pleasure, to be on the panel. I think in terms of if you ask me what kind of transactions we are seeing, then obviously it's the primary investment and secondary transactions which are most common, which obviously involves share subscription, share purchase agreements, etc. Having said that, I think business transfer, asset transfer transactions also I have been seeing in the last few years quite a few of them. I think primary reason, of course, being that let's say the seller or the business has or the company has some past liabilities, some non-compliances or some litigation or some environmental issues or some investigations from ED, tax litigation, etc., that is pending. Because of which the buyer doesn't want to, risk taking the entire entity and getting all the liabilities as well. I think the other interesting reason why we've seen why where we could also see a business transfer, asset transfer would be that, look, I think the company has multiple businesses, and the buyer is only interested in a particular business. So in that case, also I think the buyer may prefer to go for a business transfer rather than buying the whole entity. But having said that, I think what we also see is that in business transfers, there are quite a few challenges. Like for example, implementation of the transaction itself is quite complicated. Unlike a share purchase, share subscription, where there's an issue of shares and transfer of shares, and that's about it. That's the transaction done. In a business transfer, to complete the transaction, you will have to transfer each asset separately. Whether it is immovable property, movable property, intellectual property rights, whether it is contracts, insurance, and so on. So I think implementation is definitely, one of the challenges that arises, and it makes the transaction complex in that sense. The other aspect is also, real estate and stamp duty costs, because where the company or the business has a substantially high value real estate, and depending on the state where the real estate is, I think one will have to analyze, whether these stamp duty costs can be sort of deterring to undertake the transaction. Another interesting couple of interesting points that one could keep in mind when is structuring business transfer is that, look, the money will ultimately be received by the company. So if the shareholders of the company want to receive the money, then I think this may not necessarily be very tax efficient in that sense, and may involve one more layer of transaction before the ultimate seller or the shareholder gets the money. Another interesting point for non-residents and foreign investors is that, look, you can't just come and buy a business. You need an entity in India. So that's another interesting point that can be noted while structuring, a business transfer. Another interesting point is that, look, from a timeline perspective, again, one has to compare, a share purchase or a business transfer, or say a court approved merger demerger. Then for reasons, if only a particular business is sought by the buyer, then I think from a timeline perspective, clearly business transfer may be faster as compared to maybe a court approved merger demerger in terms of timelines. And having said that, I think in conclusion, it's obviously much more easier to implement a share purchase, share subscription transaction as compared to a business transfer transaction. So I think that's broadly, and therefore I think the majority of the transactions that happen are primary, secondary transactions involving the company rather than a business transfer, asset transfer. There are many other aspects that go into evaluating, a business transfer, asset transfer, share purchase. But I think to sum it up in brief, these are some of the points that I thought would be relevant.
Great. No, great job, Bhavik, to summarize such a broad question in 3-4 minutes. So great job done. But in my experience, uh, when it comes to choosing a structure, there cannot be a conversation without the tax experts. So Bhavin, over to you. Now we have heard from Bhavik several situations why and business transfer may be better than share purchase, or asset transfer may be relevant, merger, demerger. Now from a tax standpoint, you know uh, what are the key tax considerations to influence the choice between business transfer, share purchase, or hybrid structures in India?
Yeah, thank you, Prasanjit. I think what you are saying is right. Ultimately, tax will kind of also play an important role to decide which structure should we go. And what you're saying is, business transfer would be possible if you have someone is buyer is looking to acquire the 100% of business. If there are, like Bhavik was saying, primary transaction when someone wants to only invest 20%, 20% stake, then obviously the discussion around business transfer practically will not be there. That structure would be more relevant when there are 100% buyouts. If I have to look at purely from the buyer's perspective, apart from the past liabilities which gets transferred if you acquire a company, the buyer has an advantage if you're acquiring a business. So, for example, take an example: is a company which has 100 rupees of net worth. I'm actually paying 500 rupees to acquire a business. If I acquire the entire business from the seller, I can do a purchase price allocation and record the difference of 400 rupees to intangibles. But there's a possibility to claim a tax depreciation going forward, which is not possible if you're acquiring a share purchase. So from a buyer's perspective, there's a significant difference, and which typically would be between the transaction value and the net worth. Doing a business transfer makes a lot of sense because on the entire value which is recorded as intangible, I can get a 25% tax benefit over a period of time. Obviously, if you have to look at from a buyer's perspective, if you're doing a business transfer, you probably will end up incurring two level of taxes, especially if it's a private limited company. On the business transfer, you'll end up paying the capital gains tax, which is the first layer of tax. And if the money is not required in the company and it has to be distributed to promoters, taking that money out has a significant tax on distribution or the other method. So if I look at from a buyer's perspective, he will always prefer a share transfer. The money directly comes in hands and he can only pay one level of tax. From a buyer's perspective, it makes sense to do a business transfer, and that obviously will always be a fight between a buyer and seller and the other factors which will play a role to ultimately decide other than tax would be obviously what Bhavik said. Again, is there the sector which is regulated? For example, pharma. While business transfer may be better from a tax perspective, we have seen pharma transaction typically being done as share transfer. Or if you're doing a real estate transaction, because the stamp duty cost may be significantly higher for business transfer, then we probably prefer a share purchase where you don't involve the other level of taxes. Whereas for companies like FMCG or other sectors, doing a business transfer may not be difficult, provided buyer is a use of utilization of funds in the company. If you want to use it for other businesses, if you want to use it for repayment of loans, there will always be a tussle between buyer and seller on which structure to be chosen, and obviously the other factors will play an equal role before we kind of shortlist the structure. The another point which will be relevant would be, is the transaction a cash transaction, or are they looking at creating a joint ventures? Like we're working on a one transaction where we are trying to create a platform by acquiring a lot of businesses and giving them a equity instrument in that sense where there is no cash payment. In those situations, probably the share purchase and business transfer both may be inefficient, because the seller will actually get security in consideration, but he still has to pay taxes. Probably in those situations where the consideration is in the form of some security, probably merger demerger may also work out to be an ideal structure where they are still getting the security pursuant to a transaction without paying any immediate tax. So obviously the other factors will also drive, but tax will also kind of decide which structure one would choose. You are on mute, Prasanjit.
Right. Well, that's the peril of webinars, sometimes you don't view, but I think thanks for articulating the tax considerations. Now I think the audience has a good perspective as to what goes into deciding on a structure. In next segment, I will touch upon a very interesting structuring tool, deferred consideration. There will be three, four parts. I will split it up between the speakers. And first, maybe Sumit, I can start off with you in terms of what are the commercial, considerations and pitfalls in deferred consideration, uh, and how do you mitigate them? In a nutshell, if you can enlighten the audience.
Sure, Prasenjit. So, I said, it is becoming, and I mentioned, in my opening note as well, that deferred consideration or earnout structure or a contingent kind of a structure is becoming more important because of the increase in the deal sizes and the valuation. Now, it really depends in terms of how the deferred consideration is structured. Now, if it is just a late payment where buyer and seller agree on a number, and buyer says, okay, I'll pay you 70% right now and I'll pay you 30%, maybe 1.5 years down the line, then just needs to be evaluated from a buyer seller's perspective, more from a net present value perspective. But if it is contingent and it's linked to any earnings event or any other non-traditional event, like a customer retention or a customer onboarding or any product approval, then it becomes very important to how do you define and structure that from an agreement perspective. Just to give you an example, for example, if a deferred consideration is linked to an EBITDA achievement, now for whatever reason in that particular in which the EBITDA is to be taken into account, there is some unusual or unrelated business expense which happens. Now, if that is not captured in the agreements effectively, that how the EBITDA calculation will happen, then that will definitely lead to a kind of a dispute between the buyer and the seller. So a deferred consideration, though it helps in bridging the valuation gap between the buyer and the seller, but it also needs to be uh, elaborated or put down in the agreements in a manner that it's interpreted in a right manner and doesn't lead to any disputes. Another important point which needs to be factored in when you when a deferred consideration is being considered is how the entity is controlled during that period, because you are selling your entire equity stake to the buyer, but there is a significant amount of consideration which still needs to be paid out. So from an agreement perspective, one need to really build out proper checks and balances, information sharing more from a seller perspective so that his interest is protected. Another point, more from a regulatory perspective is, any transition which involves a non-resident, uh, it's important that, to note that a deferred consideration can only be a 25% and not more than that. And it cannot be deferred for more than, 18 months, especially when a transition involves a non-resident. Uh, and I think, though Bhavin will be more appropriate to talk about the taxation aspect on deferred consideration. But there is a gray area in terms of how the deferred consideration is to be taxed. It is to be taxed today itself, because
Yeah.
it is agreed in the agreement, or it will be taxed on the receipt. Now there are opinions in terms of whether it is contingent, it is certain, and how it is to be taxed. But that's an important point which a buyer and seller needs to discuss. So there are pros and cons of deferred consideration. Obviously both the parties will have to weigh both all the pros and cons in terms of before agreeing on any kind of a deferred payment structure.
Excellent. I think Sumit, since you mentioned that the contract has to be airtight and extremely well drafted, I think Bhavik, in your experience, what are some of the, you can say, tips or suggestions you can offer for the audience, basically to minimize potential of disputes, enhance enforceability in deferred consideration, or if there are milestone linked payments.
Yeah, sure. I think Sumit really touched upon quite a few points. Maybe from a commercial point of view, maybe I'll just go back again to just say, what is a deferred consideration? First of all, I think being a lawyer, important that we are clear on what it is. So I think what deferred consideration is, it is basically that you transfer the shares, and then certain amount, either the whole or the part of the consideration is left back to be paid later on. Now, when does this kind of a transaction structure come into play? So as again Sumit mentioned, I think one of the transactions that why this comes into play is an earn-out structure, wherein the buyer looks at the company and says that, okay, I will pay you a particular price now, and if the company performs consistently well, maybe in the next 1 or 2 years, and achieve certain milestones, then I will pay you some additional amount. And that's one of the situations where deferred consideration comes into play. Another situation where we see deferred consideration where it can come into play is a purchase price adjustment. So for example, you have agreed on certain price based on certain parameters in the company, and when you transfer the shares, you will not necessarily be able to determine those parameters, and you kind of do a value, you would do a verification after the transaction is done, and that involves a purchase price adjustment, which may involve a further payment by the purchaser to the seller, or a refund by the seller to the buyer. So that's a purchase price adjustment. That's again another situation where deferred consideration can come into play. And some other situations could also involve, let's say the buyer has seen some issues in the company, and he wants to keep some money, hold back some money for indemnity purposes. So these are 2 3 situations where deferred consideration comes into picture. Now, how do you ensure that as both the sides are protected? Obviously, I think a very clear and an unambiguous contract is a must. Now, when we say that, it means, as Sumit also touched upon some of those, like you need to clearly identify what are the milestones when monies get paid. Have very clear accounting standards as to how numbers will be arrived at, what policies and methodologies will be used, what formulas will be applied, what are the timelines for payment. So many aspects which need to be covered very clearly and in detail in the agreement, that should be there. That's as far as the drafting of the contract is concerned. I think another interesting aspect is, and a very important legal aspect which needs to be kept in mind, is that not always a deferred consideration is something that is going to be doable. As Sumit said, one of the situation was, I think there is a limitation that you could only hold back 25% of the consideration, and a maximum period of 18-month window over there. So I think that is one of the reasons. But another very important reason which I see gets missed out a lot of times is that in case of public companies, the transaction needs to be on a spot delivery basis, which means that the shares need to be transferred and the consideration needs to be paid on a spot delivery basis. So therefore, implementing a deferred consideration in these situations would be very difficult. You would not be able to do it from a legal regulatory perspective. So what is the way out? And because of this, I think what we see is a two tranche transaction, which is an alternative to a deferred consideration, which we all see a lot of times. So what happens is that instead of the seller transferring all the shares at one go, let's say the seller will transfer 80 or 90%, 70, 80, 90% upfront, and hold back certain percentage of shares for a later period of time, wherein the deferred consideration can be paid or adjusted through the balance shares. Of course, it involves lots of other issues, including tax and whether it's valuation and several other aspects on whether this particular objective can be achieved or not. But having said that, I think a two tranche as an alternate to a deferred consideration is very commonly seen. Of course, some of the other issues that keep coming in a two tranche is obviously because the buyer, when he thinks about the transaction, let's say is looking to buy X percentage or 100%, and then it suddenly goes into a situation where the buyer may not get 100%, so he may have to live with a seller who continues to hold minority shares in the company, and the buyer may not necessarily be happy with the interference that he gets from the seller. So that is another important aspect that the buyer needs to consider. At the same time, from a sell side point of view, you would want to make sure that all your rights are properly protected, because your consideration is going to be based on the performance of the company after, say, 1 year, 2 years, and therefore you want to ensure that the buyer does not run the business in a way that impacts his consideration. So from a sell side perspective, you would want to ensure that you have enough say and and access to information and other things in the company. Another thing is that, look, from a buy side point of view, you may want to ensure that the transaction, and the sell side perspective, look, you want to get the exit, but the buy side may not want to compete, because if the company doesn't do well, then there could be issues. So I think these are just some of the aspects that come into play when you talk about a deferred consideration. There are many more things, but yeah, some of the key ones I covered.
Yeah, no, absolutely, Bhavik. Very well put. And I think two connected points, just carrying forward your point, there should be enough disincentive for enough to ensure that the buyer or seller doesn't act in bad faith. For example, if the buyer is not willing to pay and is really clutching at straws to delay, there should be a steep interest amount which the seller should be able to claw back. Equally, if the seller is driving the business to the ground because of short-term earnout considerations, there should be enough deterrence so that kind of the business doesn't suffer just to meet the earnout consideration.
Yeah,
Yeah, Bhavi, you
just
were
to
saying.
add, yeah, just to add to that, Prasenjit, I think the deterrence that you spoke about is built into the two tranche structure. I think for the buy side, it is the nuisance value or the interference from the seller which requires him to ensure that he buys the seller. And from a sell side, he has the shares as a leeway, so therefore he has that protection, and he also wants to get the exit because the balance share may be illiquid in that sense, so he may want to exit. So I think there is enough deterrence inbuilt in the two
Correct.
tranche
Correct.
structure, which
Yeah,
kind of
yeah. Yeah, two-tier is acceptable. That's remarkably good. But sometimes buyers want a clean 100% buyout upfront, and then challenges come around. So I think Bhavin, as Sumit mentioned, that again, tax issues in earnout, where the consideration is contingent. When does seller pay tax? Because ultimately, I
So,
may be agreeing to earnout, I may not get anything. So
yeah. So, Prasenjit, again, there are two types of deferred structure. One, obviously, is, as Sumit said, a fixed consideration where only the timings are deferred. So the buyer gets a comfort around there are any not unknown liabilities which I need to adjust before I pay a consideration. If they are only fixed consideration, only the timing is deferred, I think the law is very clear. The taxable event gets triggered the day you transfer the shares to the buyer, which means a deferred fixed consideration will definitely be subject to tax on the day you transfer the shares immediately. As far as the contingent considerations are concerned, which are based on performance or linked to certain milestones, there is a gray area. So if one is to just read the way the law is worded, or probably one will come to a conclusion that there is no concept of charging tax in the subsequent year of receipt. Everything is taxable in the year of transfer. The trigger is a transfer. However, there are judgments, and as we stay in, as we look at India, there are judgments on both sides. But there are judgments to say that if the consideration is contingent and linked to a certain event, the right to receive that has not accrued to a buyer to the seller today, and hence it should be taxable only in the year when the right is crystallized or accrued. Having said that, there are judgments again on the other side saying whether it's contingent or otherwise, the transfer has happened on in year one and you should pay tax in year one. So you will always live in that gray area whether you will pay tax upfront, you will pay tax subsequently. If you decide to pay tax in the year of receipt, I think we should assume that there will be enough litigation around that, and hence the structuring to that extent becomes equally important. And I think one structure with both Sumit and Bhavik pointed out is to keep certain percentage stake or equity with the seller, which gets transferred in tranche two as and when those milestones are achieved. While you solve the ambiguity around when to pay tax, obviously we will lead to other tax issues. For example, in India, there are concept of minimum value at which you have to do a transaction. You can't do a transaction at less than the tax fair market value. There are different rules defined to determine tax fair market value. So you may actually have a situation that after say 2 years down the line, you need to transfer these shares for 1 rupee because none of the milestones were achieved. In which case, the minimum tax value still becomes taxable for both buyer and seller. So if the minimum tax value is 20 rupees and you are forced to transfer it for 1 rupee, seller will still pay capital gains tax without receiving the money. The other problem is the buyer will also pay tax since he's getting 20 rupees worth of shares for 1 rupee. So the problem is, while it's commercially and legally easy to ensure that the class some equity remains, you may have a situation that if that doesn't turn out to be the other side, then you may end up paying tax since the value at which you are doing a transaction is lower than tax value. The few structures which we have seen, to try and solve for these issues is kind of issue some form of optionally convertible instruments, either optionally convertible preferences or optionally convertible debentures. Whether debentures redemption or the preferences redemption is linked to the event, which means the terms will say that if this event occurs, I will pay you 20 rupees, which is my commercially agreed value. If those event doesn't occur, I will redeem this at face value, which is 1 rupee, which doesn't issue the tax FMV of that instrument doesn't increase because the term says that depending on event, my redemption value is changed. And it also kind of ensures that if the buyer doesn't honor my redemption payout, I have a right to convert and again become an equity shareholder to the extent of my entitlement. So this is a structure which you have seen can work out. And the problem is this structure would work if the seller is a resident. If you have a seller who is a non-resident, issuing optionally convertible structure doesn't work. Probably of some form of then convertible structure, but the conversion is linked to an event is what probably we can think of. And issuing bonus convertible to a non-resident doesn't require a pricing compliance. So probably before the transaction issues some form of convertible preferences where the conversion is linked to a milestone. So as and when you are transferring that instrument, your value will always be equal to the consideration which you need to acquire because the terms are very clearly spelling out what value you will get on conversion. But otherwise, I think there are enough issues around just paying this consideration as a contingent consideration because of the judgments on both sides.
Well, that's very helpful. Bhavin, navigating tax landmines has never been easy. So I think you have absolutely put forth all the issues, and even alternate structures have their issues on their own. But I think what I have seen is that if deferred consideration on a contingent basis is payable, it's ultimately risk appetite of the seller. Because some sellers I have seen they want to pay off the tax and later on claim refund. They don't want any tax issues overhang. On the other hand, there are people who are willing to not pay the tax upfront and rely on some of the judgments you have been alluding to. So I think
Just
moving
to
on now, yeah, sorry.
so this is also just to add, you touched upon, how does seller rely upon, whether the buyer will honor the payment if it's a deferred, and he's already passed on his entire 100%. And at least from a seller's perspective, it's very important that you build in some kind of an escrow arrangement or some kind of which is backed by a bank guarantee itself, even if escrow account is not fully funded. So there are nuances and there are issues in terms of deferred consideration, but it is being a lot being played out in terms of as we are seeing in the market because of increase in deal sizes and the valuations, and buyers not willing to put the entire money upfront.
Yeah. No, no, absolutely. I think you're absolutely right. There's escrows, bank guarantee, which has a cost. There is also parent company of the Indian company, which is made a party to add to the liquidity and solvency concerns, if any. So, very valid point. So, I think moving on, Pramod, thanks for patiently waiting. Now, next question is for you. In asset sales or joint ventures, what financial and timing factors do you consider critical?
Look, I think my other panelists talked a lot around taxation and other, but more from financial consideration is ability to finance, right? So as you know, in India, banks are not permitted to, uh, finance acquisition of shares. So therefore, we end up, using FPIs to be able to do or access the NBFC market, right? But if it's asset sale, then that acquisition is pretty much permitted. That's from a financing perspective, but of course, uh, there are, as I said, ways to overcome that challenge by accessing different pools of capital. But there are lots of other considerations that determine share sale versus asset sale, and from a uh, from just timing perspective, tax efficiency perspective, typically most of the transactions end up being share sales as well, right? So I think the other one in from a timing point of view, another important consideration outside of tax, etc., is if the business has certain licenses, certain concessions given by government agencies, etc. Asset sale leads to a huge amount of complication in going and getting those licenses transferred, which is not easy if you have government on the other side, and therefore it's always preferred to just buy the company. The timing in sort of seeking such approval and the uncertainties is huge. So I think those financing and timing perspective, I would say, between asset sale. Now, as far as JVs are concerned, I think that's a different ball game altogether. Unlike a 100% sale in JV, you really need to recognize both sides as to what each side bring to the table, why that JV is coming into being at the first place. It's very important for an efficient, from a handshake to signing of the JV agreement, and eventually for the JV agreement to, or JV relationship to sustain over a long term, is, I think both sides to understand very clearly as to what each side brings to the table and what is the eventual end game or end result that you see, right? There have been joint ventures that have been successful for several decades, and they have been joint ventures that have just outlived their utility in a matter of few years, right? So it's very important both sides be very clear as to what each sides bring and what is their eventual game plan, right? So I think those are the other considerations in structuring a right joint venture versus 100% exit.
Thank you, Pramod. Thanks very much. I think moving on to some of the deal issues now. Maybe I can start off with Bhavin first. Bhavin, in cross-border M&A, what are the issues like headline big time issues like general anti-avoidance rules, or there's the indirect acquisition of an Indian company? Any teething tax concerns which you wish to flag for our audience?
Yeah. So I think Prasanna, you are right. With GARP already been in the statute, there has always been a discussion around if you are doing any structuring, will GAR come into a play? Because some of the structuring which you are doing to optimize the tax or create an tax efficiency, you can't kind of ignore the general anti-avoidance rules which are already in place. Unfortunately, that law is in that sense very nuisance and very recent, and there are no judicial precedents around how the provisions would be interpreted by the courts or the tribunals, and the way the rules are drafted, they are very wide powers given to tax authorities. So one thing which we have been advising client is to ensure that the GAR provisions will kick in only if you are not able to justify a commercial rationale for the structure. And most of the times what we have seen is, while there may be commercial rationale which are there and there is a reason why the bankers or the parties have agreed to come to a structure, those are not very well documented. And when you look at the litigation, you kind of struggle to find documents or supporting to say that how do we justify the commercial rationale. So the important element which will be critical, especially from general anti-avoidance rule, is to try and document a rationale. For example, during one simple transaction of real estate, where we wanted to buy a land parcel for the developer, sellers were not willing to transfer the land because it was owned in a company with three different partners, which entailed double tax for them. My intention was very clear to acquire a land and develop it. The question was, if I'm acquiring a company and then since I want to do a development, I don't want that subsidiary. The intention was to liquidate the company immediately and do a project in the flagship entity. The question was, if when I do a liquidation, will someone say this was done with an intent to optimize the tax? What we had done is we had documented the rationale very well in the preamble to ensure intention was always to do a land development. We wanted to acquire land, but because of peculiar reasons, the structure was designed in a manner so that we are not struggling to justify the rationale in future. I think as far as I think indirect transfer tax are concerned, I think the rules are now very settled and clear. When will the indirect transfer will kick in? How will you value whether the India value of Indian assets is substantial or not substantial? So the ambiguities which were there a few years ago kind of is not there. And one thing which people sometimes don't realize is there are still certain tax treaties where the indirect transfers are still not taxable in India. For example, if you have a structure where there are two Singapore entity and the second Singapore entity owns India and other jurisdiction, while the indirect transfer may trigger when the Singapore 2 is selling shares of Singapore 1, but under treaty, transfer of Singapore shares by Singapore company is still governed by treaty and taxable only in the country of sale, which is Singapore and not in India. So one should be mindful that while the rules are very clear, which jurisdiction you are involved in, and look at treaty. Is the treaty still covers the indirect transfer, and hence the treaty benefit still continues?
Right. No, I think absolutely correct. I think very pertinent points, Bhavin. Thanks very much. Bhavik, turn it to you very quickly now on the regulatory aspects. So while choosing a structure, what kind of regulatory aspects, whether it's sectoral caps, PN3, which you factor in while deciding on the ideal optimal structure?
Yeah, absolutely. I think Bhavin, of course, mentioned tax being a very important consideration. I think regulatory is one of the most important aspects which comes into play. When I say regulatory, it's again a very wide topic, and we can probably have another session just to cover some of the aspects in that session. So I think when you say regulatory, it could cover FEMA, SEBI, competition laws, the other regulatory bodies like IRDAI, also our Companies Act, etc. A lot of laws and regulations have applied to these kind of transactions and have an impact on the structuring of the transactions as such. So for example, as you rightly said, I think, let's say there is a transaction happening in a company where foreign investment is, say, restricted to, say, 74%. The buyer wants to buy 100% in that company. Obviously it will require structuring. So a couple of options for the buyer and seller to consider is, look, can I want to buy 100%, so let's go upfront to the government, get the approval, and then do the entire 100% transaction. Another way of looking at it is from a sell side. He may want to get the cash on hand at the earliest, and so he would say that, okay, let's just do 74% upfront, and then we will do the balance 26% after taking government approval. So that's another requirement which will have an impact on structuring of your transaction. Similarly, I think where there is a and if it's a tranche transaction, where you're doing the 74 and 26 later on, then several other complications come into play as to what happens if the approval comes, does not come, etc. Similarly, I think another impact on the structure could be that, let's say, a company has several businesses, and the buyer is looking at only a business which is otherwise 100% permitted, but it has many other businesses also which is not 100% permitted. So in that case, one of the way to do it would be that, look, you hive off the business which is on the automatic route into another company, and the buyer can come into that new company which is automatic approval. Similarly, sectors like multi-brand retail trading, etc., are quite complex structuring. We have seen being applied in the industry today. Press note 3, as you rightly said, I think, Prasenjit, is really the is an issue which is we are all seeing today even more and more. I think sometimes we see that, look, the government may look at liberalize. Now we see that, look, they may not necessarily liberalize. So it's quite a lot of flip flops or changes in the geopolitics which has an impact. So I think that may require parties to either do an import export trade rather than a transaction, as opposed, or to make it favorable to get approval, get a minority stake if you're affected by the press note 3 for a foreigner. Similarly, if it's a SEBI transaction, where a buyer is interested, but it involves open offer, and then instead of going through the open offer, you could look at doing a business transfer. We've seen that happen in some cases. Similarly, if it's a competition commission, where there's a horizontal buyer sellers about competitors, there could be divestment issues which are there. So if the market share is very high for particular products, and you anticipate that the competition commission is going to ask you to divest something, then it is important that your structure factors that in, and you have alternates and plan A's and B's in place in that sense. And I think from a Companies Act point of view also, if you're doing certain transactions with companies, you will have to be careful about, after the transaction, if it's a group company, what kind of transactions will you be entering into with the group company, the related party transaction related aspects, the layering requirements, etc. So I think there are quite a lot of laws and regulations in India to be considered when you're structuring your M&As. Yeah.
Right. Thanks, Bhavik, for very important regulatory considerations. I think, Pramod, if I can go to you, in your enormous experience, give us few instances, real life situation where creative structuring saved the day. In other words, tackled the complexities or challenges of, whether it's a regulatory consideration or any other issues by creative structuring.
Prasanjit, I would be risking our franchise or myself if I were to say creative structure helped us overcome a regulatory challenge. But a couple of examples come to my mind, and Bhavik did allude to one, I think, which he was referring around farmer situation. I think when KKR sold Gland to Fosun, I think it was originally constructed it to be a stake higher than 74% that the automatic approval provides, and then given elongated delay or this, I think that transaction eventually changed its color and ended up being a lower stake than what's required, a government's approval, right? So that's kind of one. I think the other situation where I recall we were involved in, it was Crompton Greaves consumer business sale from Crompton Greaves, which went into a huge amount of financial challenge. We were advisors to Advent on that transaction. It wasn't really a regulatory issue, but just solving for the financial stress that the seller was facing. It was a listed entity that required a demerger, a tender offer subsequent to that. But I think the whole transaction got structured as buyer and seller, signing an agreement. Certain amount of actually consideration was paid upfront to ensure that the seller actually addresses. We ended up, providing that capital to the seller, and eventually the transaction took 9 months to complete after the demerger happened, and the tender offer took its own 3-4 months, right, to complete. So sometimes you do face these kind of challenges, but innovative structuring by lawyers and bankers help overcome some of these challenges to achieve the commercial objectives. So those are the two examples that come to my mind. I think we do see some around in the CNI where there is under 26% requirement in certain cases by the shareholders to continue, right? Or in case of a PPA award where you can't sell, for a certain period, or in a road concession you can't sell for a certain period after the concession's been awarded. I think you structure the sale in a manner that the effective, sort of, while the economic interest may transfer on the very first day, but the ownership is transferred subsequent to that regulatory limitation gets over. So there are ways in which this could be done, right? These are some of the examples.
Thanks, Pramod, for shedding some light on the creative structures. I think one last question, maybe before we take on some of the audience questions. We've got a flurry of questions, and we will spend at least 10 odd minutes to take them. Bhavin, the moment we say innovative structure, creative structure, the antennas go up. As Pramod was saying, if he says that he's deployed a creative structure to resolve a regulatory issue, people may think that something is wrong. From a tax standpoint, are there any common challenges the moment you try and innovate a structure? What are the common tax traps which one should be mindful of when devising these innovative structures?
I think, Prasenji, I'll keep it short, but I think one point which we had kind of already spoke is in today's world and time, one should be mindful of the general anti-avoidance rules and try and ensure that there's a rationale around the structure which you are contemplating. If there's a commercial need or a regulatory need to do a structure in certain way. For example, deferred or contingent consideration. You don't want that to be open-ended to ensure commercially and legally. And if there is a reason why we are doing a structure, good to document those structure. The other point which you have seen people generally tend to kind of ignore is the provisions around section 56 to 10. And especially true for infrastructure and real estate companies. While commercial, you may have agreed a transaction based on some valuation metrics or discounted cash flow. Tax has its own way of calculating fair market value, and we have seen this being a challenge, especially for infrastructure companies. Say, for example, if there's an airport entity which has a 99-year lease from the government, the reckoner value of that land needs to be added to calculate the tax fair market value. And sometimes the numbers comes out to be very absurd, and you feel that generally people feel that the tax FM will be always be lower than the commercial value, which may not be true. So that's implication under 56 to 10 one should be mindful of when you're doing a transaction. The other point, which is also critical, is to as I think Pramod said, is if you're doing a share purchase, then one other than the bank can't finance. The other challenge is if you've taken a loan on which you are servicing an interest. If you acquire a company, you don't get a tax deduction because you use the bank funding to acquire a share, so you don't get a tax break because of the way rules are kind of worded. Probably you can consider structures like merging those structures. If you just continue the structure without doing any other restructuring, then you are kind of losing a tax advantage on the interest payout which you are doing to the lenders. And one way to solve for those kind of situation is to immediately after you acquire merge both the entities so that the bank lender funding and the business comes into a single entity, and then there are chances that you will to claim the tax breaks. So those are small points. People sometimes forget that not getting a tax break may also be a significant impact on your overall return or IRR.
Thank you very much, Bhavin. I think let us now take some audience questions for next 10 odd minutes. I think the first one, this is from Mr. Ayush Bang from Otis. Bhavik, maybe you can take this. This is purely a legal question. So in case of a resident to non-resident sale, given the FEMA restrictions, which you alluded to, that 25%, 18 months, how does resident seller give indemnity to such non-resident buyer? He further amplifies his question by saying FEMA allows only 25% consideration, but for fundamental reps, there is generally no cap or 100% cap. So how does one resolve this challenge?
Yeah, it's a very interesting situation, and I think one of the most important points, which come up now, as far as the non-resident buyer is concerned, he has to get the money from the resident seller if there is an indemnity which gets invoked. I think there is a challenge. I think if it's going to go beyond the permissible limits, both monetary and time limits, which is 25% and 18-month window, then I think RBI approval will have to be considered, will have to be taken at the time. I don't think there is any other way in which you could claim that indemnity. And of course, having said that, I think what in I've seen in my experience is that RBI is considering these giving and providing such approvals on a case-to-case basis. So, for example, you go with appropriate reps warranties and indemnity language, and if there is an arbitration award, then the arbitration award, and then you go to RBI. RBI is granting such approvals on case-to-case basis. This is what I understand from AD Bank. So, unfortunately, there is no other 100% alternative, clear-cut, perfect solution to that other than the RBI approval requirement. I hope that
I think,
answers the question, Prasenjit. Yeah.
yeah, no, absolutely it does. I think very clearly it does. Uh, I think the next question maybe for Pramod. How do you creatively finance contingent payouts like earnouts without burdening the balance sheet?
Yeah, look, I think one simple way of this is, whatever incentive you're building or contingent payment you're building, you really, I think, solve for that at the time of liquidity event, right? So, if there is a X percentage you want to give it to management for them to continue in the existing business, is that for 3 years or 5 years at the time when the liquidity event happens? So, for instance, the private equity investor sells, the management's given that, or the existing founder shareholder is, really given that amount gets crystallized and is, handed over to the management team or the selling shareholders. I think that, to in my experience, has been the most common way in which that without burdening the company, people have tried to address that.
Right. It's very helpful indeed, Prabhu. Thanks for that. Uh, I think one question, maybe Bhavan, for you. This is, I think, the fact that there can be creative structures, at times overly complex structures. The question being, have you seen in your experience overly complex structure kind of harm adversely the buyer-seller relation or in the post-deal integration?
I don't think typically. So while obviously, if there are creative structures, you may run a risk of litigation that may be there depending on the structure which one is looking to implement. But you're not seen tax being a concern going forward between buyer and seller. The only point, which again is not actually a creative structure, which typically creates a challenge and where the relationship between buyer and seller continues, is withholding. The withholding has always been a challenge, especially if you're buying from a non-resident, whether you will withhold, not withhold, especially where the treaty is available. And if you don't withhold, because a seller has a withholding or a treaty benefit available, then you still run a risk that the tax officer can come after you for 7 years after the transaction is over. So keeping that withholding issue aside, where buyer and seller kind of are hand in hand together, because buyer can also receive a notice for non-payment of tax for seller. Typically, any other structure, once the structure is implemented, will not hamper the relationship between buyer and seller, because buyer tax will be buyer's tax, seller's tax will be seller's tax, and will be managed by them differently. I hope I answered. But other than withholding, I don't think that relationship kind of hampers going forward once the structure is agreed and implemented.
That's very helpful. I think that's I'm sure gives a lot of comfort to our audience members for both sides, buyer side and sell side. I think the next question is slightly involves a bit of crystal ball gazing. So maybe I will throw it wide open to this panel. The question being, what innovative structuring strategies do you see gaining popularity over the next 3 to 5 years? Maybe Pramod, Sumit, I don't know if you can kick it off because you're perhaps best positioned.
So, Prasenjit, as you said, it'll require a crystal ball, to see, what kind of things will evolve over the next 3 to 5 years. But if I just look back in the last couple of months, there is a large transaction which is happening in the healthcare space, which is pursuant to a merger, which is happening. There is a large transaction which is happening in the BFSI space, which is in a listed space, which is leading to an open offer. So there are the different structures which will play out. As I've been saying, as the valuations increase, valuation multiples increase. I think people and I think we started with the emphasis of private equity participation. So people will be open to non-cash structures, which was not the case earlier on. Also, in terms of what we have not seen in India is a non-traditional kind of an earn-out structures, linked to, so it has been linked to financial metrics, kind of a revenue or EBITDA achievement. People will still, especially if it is at a nascent stage, start linking it to, customer retention, product approval, customer retention. So those are the kind of, innovations, which may come in different structures.
Pramod, you wish to supplement to what Sumit mentioned?
No, I think Sumit sort of covered this. I agree. I think the deal making environment continues to be more and more interesting as complexity of the transactions increases, as I think certain buyers tend to be have an interesting angle. In addition to, I think what Sumit mentioned is that we recently saw in a transaction where there was a parallel process of IPO versus sales sort of was being run together, right? This was something that we hear about that in the US. We hadn't really seen in Indian context, but seller from their perspective were keeping the options open. So just dual tracking is an interesting sort of development that we've seen in the market practice that could, if the IPO and the M&A environment, you know, together is strong, you could see that being used as a way to achieve the seller's objective, right? So that's
Right. No, that's very useful predictions. Hopefully, some of them will come true, and there will be, as we move along. These are a dynamic kind of situation, so things will take its own course. Maybe one last question, Bhavik, for you before we go to the takeaways and the vote of thanks and audience poll. Uh, Bhavik, what impact can uncertainty in obtaining a regulatory approval have on structuring a deal? And what actions can be undertaken by the parties to manage such risks?
Yes, I think I had partially touched upon that point in one of the earlier responses. I think let's say, we look at either a government approval for foreign investment, or let's say a competition commission approval. These are all, both these approvals could be time consuming, and, it would involve maybe a month, 2 months, 3 months, or maybe 6 months, so depending on how long it takes. And that's a fairly long time period for a lot of things to happen, between the signing of the transaction and the actual closing. So obviously, one of the impact could be that, look, if there are certain events that have happened which are impacting the business, then the buyer may not want to complete the deal, or it may have impact on the valuation of the company itself, which could give rise to complications, because the buyer would have the challenge for the buyer would be that, look, when he came into the company, he saw the company in a particular position, and he agreed to a particular price, and he went to the regulator to get approval. But by the time he's closing the transaction, there has been a substantial impact. So that is the one risk, that valuation change. Another thing is material adverse effect. Is also another. There is a higher chance, because the longer the time period, the higher the chance, or of an MAE arising over there. I think the risk from the sell side would be that, look, he has gone ahead and announced the transaction to the world. So the world knows that, look, he is in an exit mode. So that could have an impact if the transaction doesn't go through and the approval doesn't come through. Then how would he be placed vis-a-vis his own business? So I think these are some of the issues that one would have to consider before we are looking at a transaction where there is an approval requirement and there is an uncertainty to get that approval.
Right. Right. That's very helpful. I think you can't obviously circumvent the regulatory approval. We have to take it head on and tackle it with all the dexterity we have. I think there's one more question which I will quickly take and actually respond, because I think this has already been addressed. This is from Vikas Parikh, Suntech India. In light of the various uncertainties surrounding legal interpretations and tax issues, do you see increasing popularity of R&W and tax insurance as enabler for completion of transactions? I think the word Go Pramod, I think, started off by saying that the R&W insurance is indeed gaining traction and popularity. So because you're absolutely right, that is often extremely, I would say, important catalyst to get the deals done, and is increasingly getting a lot of popularity in resolving issues in M&A transactions. Uh, so I think we are 5 minutes shy of our closing time, and maybe I can first do a very quick key takeaways, because a lot of incredibly useful points have been made by each of our panelists. So let me just try and have a stab at some of the key takeaways. I think the first, I would say, is the strategic structuring is shaping deal outcomes. And what I mean by that is, today's deal, we have to navigate FDI, regulatory aspects, valuation gaps, and we have to resolve to adopt several models like hybrid models to meet specific regulatory timelines. So we have to really factor in several considerations in order to structure a transaction, whether it's a share sale, whether it's a partial sale, whether it's a business sale, asset sale, whether it's earnout or contingent payout, etc. And keeping in mind that there is also tax angle which should be factored in. The second point I would say is deferred consideration. A lot of time was spent in today's call because deferred consideration really is a critical tool to bridge the valuation gap. And so while you deploy deferred consideration and milestone-based payments, they are indeed also fraught with risks, and therefore you have to be very mindful about enforceability, valuation leakage, tax disputes, commercial disputes if they are not drafted in an airtight manner. Sometimes you will have to keep in mind that escrow arrangements can also help in ensuring payouts are made. But you will have to be very clear in terms of what are the terms of your deferred payouts. Lastly, I would say the structuring needs to be anticipating the regulatory headwinds. So right from place note 3 to general anti-avoidance rule, in indirect transfer tax risks, forward thinking in terms of structuring is the key to avoid last minute deal friction. Real world examples were shared by our panelists, and I think they should be kept in mind to tackle those. So with that, I would say that let's go to the poll slide. I will request each one of you to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very seriously as part of our continuous improvement program. I will just give maybe 1 minute or 30 seconds to uh, complete this poll. There you go. So thank you everyone who participated in the poll. Finally, I would like to thank all our esteemed panelists for sharing their expertise and experience with us today. Your clarity, depth, and experience enriched the discussion, and we are indebted to you for the time you have devoted for this session. Also, thanks to you, our audience, for your attention throughout and your questions. I hope you found the webinar interesting and a worthwhile investment of your time today. We certainly enjoyed bringing it to you. After the webinar, as I mentioned earlier, we will send you the recording of today's discussion, a copy of the presentation, and a brief summary note recapping the discussions. You will also receive separately a request for your feedback on the webinar. Please take the time to send us your feedback, comments, criticism, and even compliments. The form will barely take a minute or less to complete. If you are interested in in-house training or any other matters arising from this webinar, please do not hesitate to contact us. Our contact information is there on the screen before you, as you can see. Uh, Thank you for your attendance today, and we look forward to being with you again at M&A Master Series. Thank you very much.